All right, and welcome to our presentation here today. This is part 2 of Retiring to Australia, our guide to long-term departure planning. I'm Ashley Murphy, the founder and principal of Arete Wealth Strategists Australia. We are a US registered investment advisory firm who work with Americans in Australia and Australians in America to bring clarity, confidence, structure, and strategy to one's overall financial life. Just a disclosure here. So today's presentation is not a substitute for personal advice. You would be well advised to seek personal counsel before taking any actions based upon what you see here today. This is of general educational nature. Do keep in mind that every presentation we record, including, of course, last month's presentation, part 1, is up on our YouTube channel. So if this is a topic, or the topics that we cover in general are of interest to you, then I would encourage you to subscribe to that channel and you'll be informed of when new videos are added. So a little bit about me, what's my background and what gives me the authority and expertise to talk about these topics. So I'm a tri-citizen, and so these issues of cross-border financial planning and investing have been with me for a long time. You could even say since birth. So I studied at the University of Queensland, moved to the US in 2005, lived there for 16 years, and I have been back with my family here in Brisbane, Australia since the beginning of the year. The plan, however, is to move back to Minnesota in August of next year. So as you'll see throughout the presentation, I very much have lived this life and have done a lot of the things that we're going to be mentioning in a little while. So Arete Wealth Strategists has been around for a little less than 10 years now. And I should mention I'm also the founder of the Global Financial Planning Institute and a regular conference speaker in non-COVID times more frequently at the FPA, XY Planning Network, Society of Financial Service Professionals. Some examples of the kinds of issues we work with our clients with are listed here. And if you feel that what we're talking about today or any of my firm's expertise could be of relevance to you, then you're welcome to go to our Get Started page. Just read, I'll take a moment to suggest you read the kinds of clients we do our best work with, and feel free to schedule an initial call. So an outline of today's presentation. First, let's recap part 1. Then we're going to go through the stages of financial transition. Then we'll go through in quite a lot of detail. I think this is going to be a very valuable webinar today for those whom this situation is relevant. I'm very pleased with what we've done here. I hope you feel the same way. But we're going to go through really in a checklist kind of format and say, this is exactly what you want to do with some time before you move. At the time of your move, do these things. As soon as you arrive, do this as soon as you possibly can. And then, well, when you get a minute, be sure to take care of these other things. So let's get into it. I should mention, I welcome question and answers, but not until the end, because we're recording this and putting on YouTube. For the sake of keeping the recording consistent, it's best that just take a note of the slide that we were on to give some context to your question, and then feel free to chat that or use the Q&A panel at the end of the session. Okay, so in the first session here on Retiring to Australia, our guide to long-term departure planning, we really looked at a composite client profile. I said I was approached by a couple in their mid-50s. They're thinking moving back to Australia, had a couple million in assets, bunch of 401ks, retirement accounts, a house here, but they knew that they wanted to retire to Australia. So what were the general goals that they were seeking to accomplish? And so to talk about the goals, we needed to define some concepts to do, say, with tax residency, source of income, et cetera, et cetera. I then demonstrated a particular tool that we use, the asset transition plan, and I'm going to bring that about in a more general kind of way in today's presentation to say, first, you need a balance sheet. You need to be able to identify what you've got and what its likely tax treatment would be back in Australia. We looked in more detail at a foreign exchange plan, again, be touching on that briefly. The transition of accounts, again, I'll be touching on that briefly today. Location of assets is the term there. And then the transition of the advisory team. I'll also be mentioning that today, just because that seems to come up again and again. So phases of the expat move for retirees to Australia. I've modified this chart, which was created by my friend Andrew Fisher, author of the Cross-Border Wealth Guide. He did it more for folks moving into the US. I'm doing this for folks moving out of the US to Australia. So really the broad stages look like this. There's the pre-move phase, where you're wanting to be taking care of immigration matters, understand your financial position and trajectory, take care of banking and cash management so that those fundamental building blocks are in place there, so you don't get hit with account closures or very low wire transfer daily limits that can be a real problem. Real estate is another matter to think about, what to do with your real estate in the US, what to do, rent or buy, when you get to Australia. Next phase is acclimation. There's the US worldwide tax. So getting used to that. If you've been in the US for some time, then maybe it's second nature, but what you'll understand very quickly upon moving overseas, especially if you're listening to webinars like this, is that as a US citizen or permanent resident, if you retain your green card, and it's really up until you submit Form I-407, you're still a US tax resident. So you get to choose between, well, you don't, let me rephrase that. You don't get to choose between Australia and the US. You're on the hook for both. And so there's a whole layer of added complexity that comes with that. I'm actually working in a very interesting case right now with an elderly Australian couple who had worked in the United States for about a decade in the 1970s and 80s. They've been back that whole time. They consider themselves Australian. Coincidentally, they actually raised their family just 2 streets away from where I live. And he went to the same high school as me, so lots in common there. So very much Australian, and he's now been made aware that by virtue of being a dual US Australian citizen, his estate plan in Australia is invalidated by the US side. So he's sourced excellent advisors in the US and excellent advisors in Australia, but because they only know domestic matters, they're giving advice that's conflicting with the other. And that sort of thing happens all the time. So it's been a very delicate exercise in communication to say, your advisors are good, they're competent, but in this cross-border context, they don't really understand how that other country's rules and regulations will change things for you. So the other thing here is getting your head around superannuation if you're turning back to Australia. Again, that's going to be different if you're remain a US tax resident. Next stage, global financial integration, getting on top of your worldwide assets and your tax filings and compliance. And then lastly would be independence and retirement. So this is really the last phase. And I think once someone has arrived here over at independence and retirement, that's when you could say that for the most part, with the exception perhaps of 401ks that linger back in the US or invest in real estate, then really that client has become a domestic client for all intents and purposes. Okay, so what to do now? This is where to take out the notebook and be mindful of these steps. So the first thing you'll want to do, and we'll talk about this, is the balance sheet, the budget, the financial trajectory. That's going to be difficult, to be honest, without proper financial planning software and training for that matter. Review your need for life insurance or disability insurance, employment mobility. That's to do with how your job is going to be placed back in Australia, or is it going to be placed back in Australia? If it isn't going to be placed back in Australia, do people make about the same amount of money? Do they make more? Do they make less? Retirement account contributions. Why is that under what to do now? Because it's almost always good advice to max out your retirement accounts before leaving the US. And then lastly, confirm immigration matters for all family members, because your plans are going to quickly come unstuck if they haven't been considered prior to arriving here in Australia. Okay, so first point about the household balance sheet. Remember, these are the activities to do now before the move takes place. So it's important to understand what you've got. Why? Because if you can't measure it, you cannot manage it. That's the whole point here. So we want to put together a balance sheet that with two objectives in mind. We understand what you've got, but also the tax treatment of that particular asset. So there'll be a little bit of more research to do for you in determining how the IRS and the ATO will deem these assets. Are they going to be taxable? Are they tax deferred? Or are they tax preferenced, such as Roths, HSAs, 529s, that kind of thing? Spoiler alert, many of the US tax preferenced items are not tax preferenced by the ATO because the IRS didn't have the manners when they came up with 401ks or 529s to consult the ATO and say, excuse me, does this comply with your country's tax rules and what you determine to be a qualified retirement account? They didn't do that. They didn't do that. So there's only, I believe it's 2 countries, the UK and Canada, when coming from the US, where there's a greater degree of recognition of those foreign retirement accounts. But Australia, we don't have that. So you're going to need to figure out what the tax treatment is of these various assets that you've got. Okay, next, complete a budget. This is so boring. My goodness, it's exactly like perhaps going on a diet, trying to lose weight, when the saying simple but not easy comes to mind. Doing a budget, really simple. Is it easy to do a good one? No, it's not, but it is exceedingly important because, yet again, if you can't measure it, you can't manage it. And if we don't know what your cash flows look like now, how can we expect to do a budget? And that's coming up next in the what to do shortly before departure. How can we expect to do a budget of what your lifestyle is likely to cost when you get to Australia? And look at what your financial trajectory is going to be. It's all based on cash flow. Next, your financial trajectory. So this is a screenshot taken from our financial planning software. The idea here is, and I often use the graphic, maybe some folks are familiar with what I'm talking about here, an attitude indicator from the cockpit of a plane. And it tells you whether you're flying level, whether you're flying up into the clouds, or whether you're flying down into the ground. That's the graphic that comes to mind when I think of this financial trajectory. When we plot out your income and your assets and the growth on your assets over time, how are you trending? You need to know that, because if you're moving to Australia, firstly, it's going to be an expensive undertaking to do it, to make the move, compared with staying in the US, relatively speaking. Of course, everyone's situation is different, but the move itself is an added cost. And then also, for the purposes of retirement planning, are you going to be looking at going on the aged pension? Or will you be living off your savings? Do you know? That's the whole point here, is determining your financial trajectory. Do you still need life insurance? This is something I've always found very interesting. I was pegged as a life insurance expert back in the early days of my career, because I started off coincidentally at a family wealth management firm that really had a lot of focus on life insurance, and so that's how I ended up becoming an instructor at UC Berkeley and Golden Gate, talking about life insurance. And what I've found is that in the US, life insurance is just so much cheaper than in Australia. In Australia, people love life insurance through superannuation because it's tax deductible. It's a default, it's an opt-out situation, and it's tax deductible. So people say, well, we mostly trust the government, there's no pernicious motivation here. If I did die and I had loved ones and dependents, whose circumstances would change if I'm not around, then sure, life insurance seems to make a lot of sense. And the tax deductible thing, it's like, well, there's no way it could possibly be cheaper elsewhere. It turns out it is. Even with the lack of tax deductibility on the US side, it is actually so much cheaper that it makes up for the lack of tax deductibility. So the very first question is, I would say, do you need it at all? If we're at that retirement phase, maybe not. There's an acronym that I use when thinking of determining someone's life insurance, and that's MEDI-REEF. MEDI-REEF. mortgage, education, debts like personal debts, income pre-retirement, retirement survivor needs, estate, emergency, and final expenses. Final expenses is a nice way of saying funeral expenses. So you add up all of that, and most of these expenses have declined over time as your dependents have matured and aged and have perhaps moved out of the house and on their own feet. So it's a good time to ask yourself, is life insurance still appropriate? I had a prospective client just a week or two ago who had been advised on obtaining a permanent policy for himself as a retirement vehicle. And in the US, that is, such things went away. What's called cash value life insurance went away in the 1980s in Australia, but for better or worse, that it still exists in the US. And rarely does it make sense. It begins to make sense after decades, but for the first couple decades, at least two, I'd say, more likely three, this is not a good idea. And it's a worse idea when you consider that the basis under which that life insurance policy has been sold, which was to do with tax-free accumulation, is not recognized in Australia. Australia sees right through that and taxes it annually. So totally defeats the point. So this is all to do with, do you need life insurance back in Australia? And then you could possibly save some money by canceling it if you got that outside of super, obtained it in the US, kept it, probably 20-year term, something like that, if you need it at all. Okay, employment and business mobility. We need to think about your job. Are you going to keep working in Australia? I am aware that the title of today's presentation is Retiring to Australia. The only trouble is I have a problem with the word retiring because I think it's so vague and it means different things to different people. Retirement to some means not working anymore. They can't look, they can't look forward enough to the day when they're not working. They can do what they want, work on their golf handicap or watch the boats go by on the harbour. For others, it's just being financially independent, having the opportunity to do meaningful work that's totally on their terms. So I don't like that. So I am just going to talk about this briefly. So will your job transfer? Do you have a business? Is that going to transfer? Do take a look at something like Glassdoor.com or talk to recruiters. That's something I've done for clients, is I've located recruiters in the city that they're moving back to in the exact field that they're in to get a really accurate sense of what kind of money that they're likely to make. And it's been interesting to see physicians tend to make the same amount of money back in Australia. Computer programmers tend to make a lot less. And then various other professionals, it's just going to differ enormously. Business tax compliance. So this is, or business compliance, I guess it would be a more accurate term here. Will you need to set up a business entity in Australia, obtain an ABN, business bank accounts? There could be a lot of work to do there. And if you remain a US tax resident, which we all know by now, US citizen or a green card holder, then you may have other complications if your business is deemed a controlled foreign corporation. It's essentially more than a 50% shareholding by a US person in that company is going to result in some additional tax filings and compliance on the US side. Could get very complicated for C Corp type businesses that are not distributing cash in Australia, but because the CFC is deemed to distribute every year, regardless of whether you do or don't. So there could be phantom income on the US side. Retirement account contributions, remember this is under the do this now. Essentially, you want to max that out. Unless you're already financially independent and you just hate your company's 401k program that much, in almost all instances, it still makes sense. And here is why. And I say this again and again. Very commonly, the investment choice in your 401k won't be as good as what you might be able to choose outside in an unrestricted brokerage investment environment. I get it, but that's not the point. The point is this. If you're in your premium income earning years, you're very likely in your higher tax bracket or in a higher tax bracket than what you're likely to be in retirement. So we're taking a tax deduction here and we're possibly paying tax at a lower marginal rate. That's the whole point. It's not the investment selection. It's about the tax alpha, the difference, or I should say the tax delta between where you are now and where you're likely to be in retirement. Confirming immigration matters for all family members. This was near and dear to my heart. You would have seen I did a 4-part series about the move that my family did here. So happens my wife is an American citizen. She's not an Australian citizen. For the length of time of the trip that we're talking about, it actually made sense to put her on a tourist visa as compared with applying for a permanent residency, given the complications that the cost, I should mention, which is about $8,000 in Australia. So it was kind of a wealth tax that Australia has there. But also the fact pattern where we didn't intend on sticking around and fulfilling these other requirements that were needed for that permanent residency application. So just making sure that everyone's going to be taken care of. I've seen this recently with clients where the parents, let me see, the parents somehow don't have Australian citizenship. That's it. They don't presently have Australian citizenship for their kids and moving back to Australia. However, by being Australian citizens themselves, they'll be able to get it for their kids. So it won't be a problem, but it's something they'll need to take care of in advance. What to do shortly before departure? How would I define shortly? I would say begin reviewing this list within 6 months of departure, 3 to 6 months, depending on how much spare time you have to act on the list. So 3 to 6 months before departure, we want to be looking at that budget, thinking about what life's going to cost in Australia, determining your short-term cash needs as you book your tickets and as you arrive, positioning assets to move, executing on your foreign exchange plan, re-enrolling in Medicare here in Australia, selling your use assets in the US, we'll talk about what that means, shipping and logistics, supplemental document checklist, and real estate, what to do. Okay, so this is where having put together that balance sheet is now going to pay off, because you can begin to identify what accounts may be eligible to transfer and what accounts may be stuck in the US. There are also tax opportunities that you can take advantage of given this move that's coming up. What to do with real estate? We'll talk more about that a little later on with that dedicated real estate topic. So putting together that household balance sheet, this is what it looks like in the software that we use. You can see assets and liabilities. Then we've got non-qualified. That's a fancy way of saying taxable, cash, taxable investments. Good news is the taxable investments, they're really unrestricted in terms of being able to move back over to Australia. Just this is a demo here, so of course superannuation doesn't actually appear there, nor there, nor there, but these brokerage accounts would in fact be taxable investments. And then we've got our retirement accounts of various kinds and stock options. Stock options, pretty complicated what to do with those. The taxation can be quite tricky. Okay, budget for living in Australia. This is where having done your budget pays off. You could go to these two websites, Expatistan and Umbio, and compare how your cost of living will differ depending on the city you're coming from and where you're going to. I did this myself in preparing for this move. I did a budget. I know exactly what our monthly, non-monthly, discretionary and other planned purchase savings goals were in the US, and then I could look at that and see how it compared in the move to Australia, and then throw in a little bit of a variable for currency fluctuation. So I happened to add in a 4 cent either side of the prevailing exchange rate at that time and said, okay, if the Aussie dollar moves against me, then I can afford up to this level. And so there was a built-in buffer. And 4 cents, despite, I don't know how that lands for you exactly, but that's a reasonable amount of variability. And in fact, in the last 9 months, we have seen that. We have seen the Aussie dollar come down from around high 79 cents to hit a low of 71.5. It's now shot back up. We're now at 74.7 today. I suspect, based on the back of the energy crisis going on in China and the demand for commodities and what that's doing to the Australian dollar with the demand for Aussie dollars. Determining your short-term cash needs. So you'll need to go through and figure out, I've got some one-off expenses coming up. But not all these one-off expenses are going to be incurred in one currency. You're going to have things that will be incurred in the US, like for instance, if you need new luggage, you're going to purchase your flights, various other things that are going to be done here that pertain to the move. You'll obviously need US dollars for that. But then when you arrive, other things to consider. If you're coming in the next month, then there's still quarantine to think about. Don't forget deposits on rentals, renting a car until you buy a car, furniture, moving of goods, household goods, and furnishing your house. All of these things, buying a car, registration on the car, all of these things add up. So depending on someone's circumstance, we typically on the lower end would use somewhere between 40 and 50,000 for all of this, up to 200,000 for higher net worth, higher income clients, just to get situated. This is just before they've purchased, before they've been settled and have been here for a longer period of time. Okay, positioning assets to move. There are going to be certain accounts that are going to be easier to open from the US rather than from Australia. Also, your custodial choices will become more restricted once you move, because there's only a couple of custodians that are comfortable with folks in Australia in the first place. Okay, so open those accounts, probably a rollover IRA, we'll come into it, a taxable brokerage account if you don't already have one. That may be simply at the right custodian, and foreign exchange account. We've mentioned AFEX, OFX, TransferWise, etc. So having that all set up in place is just going to relieve your stress once you actually arrive, and a big bill comes along that you need to pay rather quickly. You want to have that infrastructure already set up in place and ideally tested before you move. Another thing that catches people out, this is possibly the biggest, oh man, moment. Wire limits at your bank. Wire limits at your bank. Why do I mention this? I have a client, or had a client, he's successfully transferred, moved to Australia. He's set up with a local advisor, and he has fulfilled his mission. Very happy, very satisfied. But we've really done for him what we set out to do. Took a couple of years, and he's riding off in the sunset. He's achieved his financial goals. But along the way, we encountered this. Before he moved, he did not follow our instructions and happened to complete paperwork at his bank. And that meant that he was limited to a $25,000 a day wire movement. It happens that the client was worth about $4 million. And it took us, it took about 3 months, because I think it's also limited to business days too. It took about 3 months to move his assets just into an investment account before it could even be converted to Australian dollars. So a potentially massive headache. The way to avoid that would be to visit your bank, sign the paperwork that needs to be signed. It's still very, very old fashioned, but they want to see you eyeball to eyeball, face to face. Get that done. And then with various banks, I know this is the case with the City National Bank, definitely don't recommend them, but I know it's the case there. And then also Bank of the West, who we have had good experiences with, they have unlimited wire transfers, so that can avoid that. So if you're cashing out, if you're selling your house, or whatever the case may be, so, moving big investment accounts, and you don't want to get hit with this wire limit, then that will be something you'll want to take care of in advance. And then adding Australian bank instructions. This is another one of those things, a tedious administrative item to do, but by adding the Australian bank instructions, when you arrive in Australia and you need to send over thousands of dollars, it's already set up in place. I know Interactive Brokers, despite having the absolute #1 best foreign exchange spreads, they have a rule that's where they impose a 40-day hold on adding a new foreign bank account instruction. So if someone wanted to set up that IB account, convert their money, and then just take it out straight away in Australia, wrong. There's a 40-day hold. That sort of thing could be very inconvenient. So executing on a foreign exchange plan, I've done a whole lecture on this. Our practice has actually developed a little bit further on this one, but Essentially, you'll be looking to choose a foreign exchange conversion timeline. You don't want to be exposed to the spot rate at any moment, because it could be a bad time, or things could be trending worse for you. We just don't know. No one knows the future. So convert that in a quarterly installment schedule over a 12 to 24-month time period. Using limit orders. What's a limit order? Limit order is where you say trade at this level. If it hits that level, and if it doesn't, then don't trade it at all. We actually use one cancels the other. So we create two limit orders, one on the high, one on the low, so that clients are protected in a corridor of rates. So if rates happen to worsen, we can sell out there and it cancels the other order. Or if rates improve, then we can sell there and it cancels the other order. That way we avoid volatility executing both trades, which would not result in a good outcome. So foreign exchange, yet again, like many of these things, it's relatively simple to understand. It's just not so easy to get it in place. Medicare, you can actually enroll in this before you head back to Australia. This is in the shortly before, I'd say no more than 3 weeks before departure. You can re-enroll, let them know you're coming back. And then for Australian citizens, you should be covered from as soon as you arrive. So hopefully no accidents befall you in that initial period before you can actually confirm that you have coverage in Australia. You'll need to complete this Medicare form. Another thing to consider is the lifetime health cover loading. Essentially, it's using that word loading in a lovely euphemistic manner. So it means a surtax if you didn't obtain hospital cover over the age of 30. But if you're living overseas that entire time, then there is an exemption. So you're able to get out of that if you can prove. I had to apply. There's a government department that sent some certified movement records, and strangely, well, maybe not so strangely, one government department doesn't talk to the other. So it was necessary to send it over to my health insurance company and say, actually, I've been out of the country since I was turned 30, so therefore this doesn't apply to me, and therefore saved this surtax. Next, selling use assets in the US. What's a use asset? A use asset is a car. It's something you use. It has value. It is a home, an abode. It is your personal possessions, your sporting equipment, electronics equipment, all sorts of things like that. That's differentiated from collectibles, so artwork, musical equipment, etc. Wine collection. That's different. Let's refer to that as collectibles. But use assets, certainly cars aren't coming with you. Neither are houses. So big decision to make there on the house. The car, not so much a big decision. You're gonna have to sell it. So best to do that while you're in the US and rent a car in the meantime. I'm going to tell you from the School of Hard Knocks, the most stressful thing, number one most stressful thing that happened with my move was that there was enough going on. I was too busy. I couldn't have done it anyway, but I didn't sell my car. It took my father-in-law 6 months to sell it. And the worst part was that we needed to get a power of attorney in place, doing that from overseas, paying to get a notary in the US, and they charge $50 per signature here in Australia to do a single signature. Then it takes a month to send it, even if you send it express. So it was an absolute nightmare, but eventually did get it sold. I would have much rather sold that in the US and just driven a rental for the last week or two before departure. POA is power of attorney, in case anyone's wondering about that. Shipping and logistics, getting the appropriate insurance coverage for your goods. Of course, it's going to vary tremendously depending on your circumstance, how much stuff you're sending back, or whether you're just intending on buying everything new in Australia. And new doesn't have to be new. Remember, there's Gumtree, Facebook Marketplace. You can get a lot of good stuff, and you don't have to pay full price for it. And there's also the environmental impact of upcycling, as it's referred to. So make sure, I'm a big fan, as you probably gathered, I'm a big believer in insurance. I love that feeling of being, of transferring the risk onto someone else and knowing that with a reputable insurer that they're going to take care of that claim should that issue arise. Thankfully, it rarely has, but in the 2 instances where we've had big claims in the last decade, the recommended insurer that I use in the US excuse me, they were the exact opposite of what our contractors had ever encountered before. They said, instead of trying to be screwed to the ground for every penny of what it would cost to replace it, was the opposite. They're like, oh, let us know if you need more money, or if that's within, you know, if there was a scratch on our floor, and they said, we need to redo your entire downstairs floor, when there was like a quarter-sized scratch on our floor when we had this ice dam issue that happened with the Minnesota winter back in 2018, 2019. Anyway, replacement cost is the point here. If you ship your not that TV is a bad example. If you ship some electronic item, let's say your laptop, and it goes missing, and you say, well, gosh, I only bought that secondhand and it was $1,200. Well, replacement cost, if you have to buy that new again, it's probably not going to be $1,200. So that's the point there, is insure for full value. Be sure to check your unclaimed property register in the state. Whoops, I got one slide ahead. In the state that you're in your state. You can be surprised. There can be sums of money out there that are unclaimed, that are yours, and you're fully entitled to. Yet again, I have been the beneficiary of that as well. Check your credit report to confirm accuracy and that all intended accounts are closed. That's more an item I would recommend doing if you were intending on or wanting to keep open the possibility of returning to the US. Okay, so supplemental document checklist. This is something we make available to clients who just go through. There's like 3 pages worth of different things that folks might be wise to think about in obtaining before they move. Real estate, really, really important. I think I've got pretty simple go-to advice if you're moving from Australia to the US, and that's get rid of it. It's really simple. Australia has all kinds of penalties and fees and losses of exemptions and ghost taxes and non-resident tax rates that strongly disincentivize having Australian sourced income when overseas. But going the other way around to Australia, I don't think it's as bad as that. And especially for a US citizen or green card holder, if you had a strongly cash flow positive property, you've got to file your taxes anyway. So it's not creating a tax filing that wasn't otherwise going to happen. So we've eliminated that particular problem. But there's still all the issues of property management from overseas and time zones and all the rest of it. Can they be dealt with? Yes, yeah, I think they can be, but you need to see, what the opportunity set looks like when you get to Australia. It's probably going to be really bad, and I say that because of what's happened with COVID, with interest rates going to zero. Property prices in Australia have accelerated at some of the fastest paces on record, and so what we're seeing now in the major cities is all-time highs. So we've surpassed the global financial crisis prices. And what we know about prices and rents is that they don't always keep together in lockstep. And so what we have is, while rents have increased a little bit, prices have increased significantly. And so therefore, if you're looking for investment real estate to make money on the rental, hopefully make money on the sale too, of course, but to make money on the rental is going to be increasingly difficult. So run an APOD analysis. What's that? Annual property operating data. It's a certain kind of real estate analysis to determine if in fact your property is cash flow positive or not. The buy rent decision in Australia. Okay, so I think I was just alluding to that momentarily or a moment ago with what I mentioned there about buying at these elevated prices. Do I see things coming down? Not necessarily. I think property, for the most part, tends to plateau. Growth slows down, but rarely, not never. We saw this in 2017-18 in Sydney, but rarely does it go backwards. Real estate does tend to be a pretty well-insulated asset class from major losses, particularly in Australia, where the mortgage lending laws are quite different to what they are in Australia. In the United States. So in Australia, there is no such thing as a non-recourse loan. So you are personally on the hook for that property. You can't send them the jingle mail, send them the keys in the mail. If the property is underwater, you're still on the hook. You still got to pay. So the experience of unwinding and deleveraging from the global financial crisis was significantly less problematic for the banks, note for the banks, from the global financial crisis because of the lack of that non-recourse debt. So what to do? You're going to have to live somewhere. So you're either going to be buying or renting, and you're either going to be buying these highly elevated prices now, or renting for a period of time and then buying at highly elevated prices later. The thing is, it all boils down to your opportunity cost of capital. What can you do with your money in the meantime? And as much as people like real estate, and boy, do Aussies like real estate, the fact of the matter is that the stock market has way outpaced the growth that we've seen in real estate. Despite strong real estate growth, it's nothing. It is nothing compared to what we see with the stock market. So then another question arises, and that is, if you are sure that you want to buy, do you buy now or do you wait until your arrival? So I'm speaking with a client of mine tomorrow. She's planning on moving back early next year. She's making good money working in New York as a physician. She'll be moving back and also making good money working as a physician in Sydney. There are, in fact, we have a relationship with a mortgage broker who's able to secure financing prior to the move. So they actually have two services. They have a buyer's advocacy service, which is where they will be your eyes and ears on the ground, and they will help you locate a property. They'll go to the open house. They'll, kick the tires, so to speak, and then help you with the mortgage financing as well. So that would be the buying now or renting and then waiting until arrival in Australia. We also have this link to a stamp duty calculator. That is perhaps something that that could be thought of as a short-term cash need, but it probably makes more sense to include that here under the heading of real estate. When you think about buying, there's not just the purchase price, but also stamp duty as well, which can add quite a bit. Let's see how we're doing on time here. Okay, what to do at your earliest convenience upon arrival. So I struggled to find the right phrase there. What to do immediately. I don't mean as soon as you get off the plane, get out, international roaming and call and take care. I just mean, within the first week or two, really as soon as you possibly can, you want to take care of your insurance, certain insurance coverages, revisit low basis US investments, inquire about separation of service from your US employer, and PFIC considerations, which we'll talk about. So what I've noticed over the years is disability insurance. I'm a big believer in it for younger folks in large part because your most valuable asset is still probably, in all likelihood, your future earning income potential. And yet, despite that, despite the greater probability of that asset, i.e. your body being impaired compared with other assets we do insure, like our cars and our houses, and despite its greater value, so higher likelihood of impairment, higher loss potential, people still don't bother with disability insurance, which is why I think it's a good idea. I also love reminding people that I'm fee only, so I don't get paid any commission for making that recommendation anyway. It just makes sense. The thing is, it's not portable back to Australia. So if you obtain US disability coverage, move to Australia, there is one carrier, Lloyd's of London, but I don't particularly like their policy, wouldn't recommend it. So you're likely going to get obtain coverage once you get back to Australia. You'll also want to obtain the appropriate auto, renters, homeowners, and excess liability policies. Excess liability is not such a thing in Australia because of liability limits for a lot of different kinds of things, and also the lower loss assessments and the lack of punitive damages that exist. So it is a thing, it does exist, but it's really not that common. Revisit low basis US investments. We had to work on the wording of this slide a little bit in leading up to this presentation because it's very specific what I'm trying to say. If you are not a US tax resident, i.e. you are an Australian who was in Australia, who was in the US, either on a visa or was not a long-term green card holder and has since submitted that I-407, it's been successfully processed, then this is good news for you. The ATO deems the basis in your assets, in your US assets, to be the fair market value on the date that you resume Australian residency. What does that mean in English? It means essentially you're getting a step up on your asset. So if you purchased Amazon stock or Google stock or Apple stock or whatever at some crazy low cost, you got it at the IPO, and that you've got millions of dollars of embedded gains in that stock. The good news is that when you move back to Australia, you don't have to pay tax on that gain if you're not a US tax resident. So that's why I say revisit it. It may make sense. If you feel the best days are behind that particular stock and you've been wanting to sell it for a while, then it would be good to consider revisiting that. Do remember that when you arrive back in Australia, any gains that occur from the time you return and assume Australian tax residency till 1 year afterwards would still be short-term capital gains. So that would be taxed at your prevailing marginal rate in Australia. Inquire with your Human Resources Department whether a separation of service notice will be provided. So what's that SOS? Unfortunate acronym, but essentially it's saying to your 401k custodian, we can release these funds. That's what a separation of service notice is. Typically takes about a month. I don't know how or why it takes a month in the age of digital communication, but it does. And they'll say, oh, this person no longer works for us or the US entity. If you're in a global company, I've seen this many, many times, they'll move from the US to Australia. It'll be a different business unit, different registration, lots of different things. And they will generate that separation of service, which will allow you to roll over that 401k. Sometimes they don't do that. They say, no, this is all one big global company. You've not moved, and we're not going to create that notice. And that means you're going to be stuck with that 401k for as long as you remain at that company. PFIC investment consideration, really simple. If you are still a US tax resident, and I've defined that a number of times just today, and I do it every single webinar. If you're still a US tax resident, you need to watch out for passive foreign investment corporation rules. It's a punitive tax that essentially means if you invest in any foreign managed funds, ETFs, really any kind of managed investment at all, it's going to be taxed punitively by the IRS. So you don't want that. The only way around it that I think is viable, and even then it's a bit tricky and there are high minimums involved, is an individual stock strategy. So you own the individual shares of Telstra or QBE or Westpac or whatever. I don't recommend those shares necessarily. I'm just saying those are examples of actual companies. You buy those shares directly. You hold those shares directly. Then you don't have a PFIC, but you are invested in Australian companies and exposed to the economic trends happening here. What to do at your leisure upon arrival? 4 things here. Determine your asset location and redomesticate those assets that were part of your plan to move. Update your estate planning documents. Transition your advisory team so that you've got the right advisors and the right seats and places, and tax filings and compliance. Okay, so essentially we're putting that plan to work. That's what we have here with redomesticating assets. We're looking at the tax treatment. Will you get that step up in basis we just spoke about? What are your thoughts about the currency, about where the Aussie dollar is going? What are your thoughts about investment choices and costs? Hint, hint, Morningstar in their biennial Global Fund Investor Experience Study consistently say the US is the lowest cost, broadest choice investment environment. So for a couple of those reasons, you may decide to keep some portion of your money back in the US. And if you do that, then you'll need to make sure you're with a custodian, you have a management plan in place so that it doesn't get closed on you and that your investments stay in balance on a global basis. Okay. And then point 2 here is the integration of that foreign exchange plan that I alluded to, where you would look at converting those assets over a 12, 24, or even 36-month period in order to dollar cost average into the Australian market. Next, you'll want to update your estate planning documents. Despite there being this so-called global will, the US recently, I think it was 2016, became a signatory to a UN charter on global wills. The fact is the estate planners hate them, and they don't like them because here's the big problem is that those wills need to go through probate in each country successively. So not in parallel. It's not like you submit for probate simultaneously. It's you've got to get probate granted in Australia and wait a year or however long that takes. Then you've got to get it in the US and wait 2 years or however long that takes before the estate is distributed. So that's a problem. International estate planners tend to like to have wills specific to the assets that remain in a given country. So you also want to update your powers of attorney and trusts. Again, that's a wormhole if you are still a US tax resident, the trust, because trusts in Australia can be invalidated by certain tax rules and regs in the US. How to transition your advisory team. This is, I said this to a client just last week. She's selling her business, moving back to Australia. I said, it's been an absolute privilege working with you. I've loved every minute of it. However, the day will likely come in the next year or two when I need to pass the baton on to a local advisor. And thankfully, I do know a whole bunch of advisors in Australia, in all of the capital cities. And so I can make a referral to you for someone who I think is competent. And essentially, I will be your sue advisor, your backup advisor. If you want a second opinion on anything, if we're still engaged, if we're still helping out with investment management of some kind or another. And lastly here, tax filings and compliance. This would only be relevant to an Aussie only citizen if they had US sourced income, namely from a business trust or real estate, or for US tax residents, as we've talked about before. So they'll need to get up on their filings, the FBARs, FATCAs, all the foreign earned income exclusion, foreign tax credit, all that stuff, and then identify the appropriate tax team. I am pleased to be working with the team. I've got a team in Australia that I don't own the business, by the way. I'm referring just CPA firm that I like, that can really go deep. Will do business taxes, do real accounting work, and is very heavily knowledgeable about the US side. And then same thing in the US. I've got a US CPA firm that I think really knows what they're doing too. Questions, concerns, doubtful points. Now would be the time to answer those. So Corey, who wrote in and said, for the lifetime health cover, would the exemption apply if there's a gap in coverage before returning to Australia? A year gap of no hospital coverage due to traveling. Probably not smart to go uncovered in the US, that's for sure. Actually, for the US, I would recommend looking at Insured Nomads. That's a company that I know does really good travel insurance that would work for shorter term stays back in the US. Do I know if there's a gap? If there is, I think there is actually. That's something to look into, Corey. I don't know off the top of my head, but I'm pretty sure I recall there. Yes, there was. You've got a certain amount of time to get private health cover. Otherwise, that loading will apply to you. Are interest rates higher for someone buying before they arrive in Australia from said mortgage lender? No, actually, they're equivalent or lower, strangely enough. That really gets people interested. When I say that, they're like, hold on a minute, how can that be possible? Well, here's how it's possible. The gentleman that I work with, he pays a referral fee, but we're a fee-only firm, so we don't take referral fees. We refund that back to our client. And he has a very well-rated book of business by Westpac. What's that mean? That means that he's able to offer a lower loan-to-valuation ratio, or correction, a higher loan-to-valuation ratio loan than what you could get as a retail client walking in off the street. So this is a rare instance of where applying from abroad, despite the risks of buying from abroad, unless you were to make a trip back and visit the property and so forth, could in fact result in a better mortgage outcome, especially at where we are in the interest rate cycle presently. It would seem to me that with the COVID recovery gradually taking place, that in 18 months' time, we're probably looking at higher interest rates. Ron Larson. Hi, Ron. I have a lot of home equity. Have you looked into pension loans scheme? No, I have not looked into that, or Australian reverse mortgages. No, nope, I haven't. A reverse mortgage is in the US at least, is a different product that's available to someone over the age of 62. It's either taken as a lump sum or as an income stream, or as just simply a line of credit. to help them with retirement security. So that would, I'm not sure what you mean there in that Australian context. The other funding option that I really like tends to only work for higher net worth folk is doing what's called an S block, a securities-backed line of credit. We're able to use one stock portfolio as security on a loan, borrow that money at really ridiculously low rates, like 1% kind of thing, and then use that, convert that to Australian dollars, and then you go and buy your property, quote, for cash. It's not really for cash because you've got a loan on your stock portfolio, but you buy it for cash without mortgage financing in Australia. So that's really simple. In fact, ridiculously simple. It's simply just set up a wire transfer. Would I recommend you do that? Absolutely not. That is any form of margin lending. I like to analogize that to using gunpowder. It's extremely powerful. It can be a game changer. It can be a force multiplier. But if used incorrectly, you can lose an eye or an arm or worse. So we tend to be very conservative about our loan to valuation ratios for those, but there certainly have been circumstances where clients have got several million in a portfolio and they can just come to Australia and buy for cash. So that works out very nicely. Thank you, Ron, for including that link there. I'll have to check that out. Looks like that's a Centrelink service. Yeah, it is of some sort of pension loan schemes. Okay. Any other questions? I know we'll be up for time in a few minutes, but I found people are typically tongue-tied or spellbound by what I've said over the past hour before the questions start to flow. So I will have to get going in a few minutes. Laura, so as a US citizen, Australian citizen couple, what is the best tax filing status before you return to Australia? Well, that's easy. That's really, normally these questions would be, well, it depends, right? Well, your questions has all the information here that I need. What is the best tax filing status before you return to Australia? About the only circumstance I've ever seen where married filing joint does not apply, assuming you're married. You say you're a couple, that doesn't necessarily mean you're married, but assuming you're married, that would definitely be married filing joint. Yep, okay. That would definitely be married filing joint unless, this is the only time I've ever seen it, unless one of you has a really large US student loan balance and you've entered into an income-based repayment plan just based on the earnings of one of the spouses, and there's a significant income earning disparity between the two of you, then it may make sense to do married filing separate. But generally, the thresholds are lower, married filing separate, the exemption phase outs come in earlier. Super simple, married filing joint. Joyce, how do you deal with different tax years when doing Australian and US taxes? Well, unfortunately, there is no easy answer for that. You're on, if you remain as a US tax resident, then you're on that 6-month filing cycle. So you better love taxes because yeah, you'll be on that for the rest of your life. Yes, it was easy peasy. Corey, what are reasons you would roll over to a self-directed IRA from a 401k over transferring to a super? Great question. So firstly, I would never recommend a self-directed IRA. That's to be specific here for folks on this call. A self-directed IRA actually has a very specific meaning. It doesn't mean simply your own rollover IRA. That's different, and that maybe is what Corey meant. A rollover IRA is going to restrict your investments essentially to everything that's listed. So all the stocks, ETFs, managed funds, et cetera, et cetera. A self-directed IRA is the equivalent of, say, a self-managed super fund, where you can invest in real estate and Bitcoin and future, all sorts of exotic investments. The thing is with that is that many of the tax advantages of having an IRA suddenly, let's say the IRS tightens the thumb screws on self-directed IRAs, and they very rarely, I have never, ever, ever recommended one, ever, not once. And don't forget the administrative fees for them as well. They're very high. The only way the custodian's making any money is by charging a fee directly for that. So I don't ever recommend self-directed IRAs, and I definitely don't recommend them for real estate because of the restrictions on lending, the different loans that you're forced into getting, the fact that you can't do any work on the house yourself, otherwise that's considered a disqualified contribution to the investment, et cetera, et cetera. All right, we're at time. Doesn't seem to have been any new. Oh, excuse me, there were 3 in the Q&A panel. I'm sorry. Pete, hi Pete, hope you're well. Thank you for your lovely note. Why is Citibank a bad choice? I was considering it since they have a presence both US and Australia. You know, I can't remember. It was in March of this year. HSBC and Citi both announced international retrenchment plans, and I think it was Citi that as well as HSBC that was looking at removing their operations from Australia. Do be mindful of the difference between corporate banking and retail banking. I can tell you that in Brisbane, HSBC have, what, 2 branches, I think, in the whole city. And if you go into Google Maps and look at their reviews, they ain't good. So I wouldn't do it. I would have in the past, but really, given the plans to eliminate HSBC in particular to eliminate their support for Australia in the coming months, actually they're eliminating in the US. That's what they're doing. They're eliminating in the US for all but high net worth. I know that for sure because I spoke with their private banking rep in New York about that. But I forget what their plan is in Australia. In either case, so even though my memory fails me for exactly who's doing what in which country, I know for sure that there is now soon to be no bank that will consistently work from both countries. That being said, Commonwealth Bank does offer a US dollar bank account. It's not technically based in the US, who cares, right? If it's still in US dollars, that could still be a benefit. But I think these other ways, you know, using OFX, AFX, interactive brokers is going to result in a superior outcome anyway, because if you've looked at the foreign exchange spreads that the banks charge, they're all terrible. I mean, across the board, they're all terrible. Grant, hi Grant. What should I be doing with the money in my 401k once I'm in Australia and get the separation of service notice? Is it better to just leave it there and withdraw it when I hit retirement age? Grant, that's going to depend on whether you're a US citizen or US permanent resident or not. If you remain a US tax resident, you don't have a whole lot of choice. You're going to have to leave that either actually able to distribute that, which as my internet connection may have gone off for a moment there. I was just answering Grant's question here about what to do with 401k. First point is, if you're a US tax resident, that's going to determine your opportunity set. And then the second thing is, if you're not, if you're an Australian tax resident, you'd roll it over to an IRA, and then you could distribute that, taking a position with the tax treaty, get that money out of the US. Australia's going to have its own treatment of how they deem the basis of that account, which will be as a foreign trust, the taxable basis of which being only the growth on the account. Employer and employee contributions are considered the corpus of the account, and then you are free to contribute it back into superannuation. Probably the best tax move in Australia, but you're not obligated to. A lot of folks think that because it went from one retirement account, it must therefore go back into another, but it doesn't need to. It's just that super is likely the best place for that to go. Last question, I'll take the delay to access the account once you move to Australia. Yeah, I'd recommend Schwab instead, or Interactive Brokers, but probably not IB. IB is not for the faint of heart. You kind of get what you pay for with IB, so super duper ridiculously low trading fees and expenses, margin loan expenses, mean that their user interface is not simple. The customer service is kind of like calling Google if you've got a problem. Interactive Brokers, right? Calling IB is like calling Google. If you found a problem on the internet, you're going to be waiting a long time to talk to anyone, and whether they can help you or not is another question. They won't like me saying that, but you know what? They really need to fix their own house before they take issue with criticism. So that's all I have for you today. I hope you can join us next month. We haven't made an announcement on the topic yet, but typically in the 3rd or 4th week of the month, we'll host our November webinar, and I hope to see you then. As I mentioned, if you feel that we can help you out, then please go over to our Get Started page we'll be happy to speak with you on the phone. All the best. Have a great day.